What's going on, guys? It's Henry. Today we're going to master selling options for income. I have a lot to cover today, and specifically we're going to cover an introduction to options, how to buy them, how to sell them. We're also going to specifically talk about trade management, like rolling and closing positions. So this is going to be a very essential video that you want to make sure that you watch all the way through, especially if you want results like this. In the past month, I made $134,000. As you can see on the right-hand side, a lot of my positions have been winning a lot of money. In fact, a majority of my positions have actually won money, and I am doing this on a consistent basis during the market downturn. I've done far better in terms of volatility than every other investor, as well as the S&P 500. Right now, I'm also recovering with the market while having very safe positions. So I want to show you exactly how to do the same. We're going to focus on selling options because selling options is a very successful way to collect income on a weekly and monthly basis, so you have consistent cash flow. Also, make sure that you sign up for my free email list. It's the first link in the description because I'm going to send you further information after you watch this video on more rolling strategies and how to manage your trades even better. Now, in this video, we're going to talk about selling cash secured puts. This is one of my favorite strategies. Selling covered calls, how to do this properly and all the benefits associated with it. And then we're going to talk about executing a trade and how to manage a trade once you have entered a trade. All right, so the first one is selling covered calls. This is one of my favorite strategies because it's so simple. Yes, it requires 100 shares, but you can always buy 100 shares of something that's very cheap, such as Oatly or Hims. Oatly is about $350, Hims is about $500. So with a very small portfolio, you can still run covered calls. Nobody said that you have to buy Amazon or Google or something expensive, but if you do have a medium-sized portfolio, that's also amazing because selling covered calls brings in a lot of income, and the bigger your portfolio is, the more income that you're going to collect. But even if you have a small portfolio, you can still collect income, okay? So a covered call, what is it exactly? It's when you buy stock, 100 shares of any stock, and then you sell calls on a share for share basis. So the covered call seller, the writer or the person writing the calls is you, okay? So you have the obligation to sell the stock if you're assigned. Now, assignment typically doesn't happen. I'm going to show you an example in just a moment, but typically assignment doesn't happen unless it's the last day, it's the expiration day. And then in that case, maybe you could get assigned, but I'm going to show you how to manage a position to not get assigned. But also getting assigned isn't such a bad thing because if you bought the stock for, let's say, $100 and then you sell it for 110 and you're forced to sell it for 110, that's not really a bad situation to be in, to be honest. So you get to sell at agreed upon price, the strike price. You actually get to pick the exact strike price at which you will sell the covered call. So you can't really go wrong with selling a covered call so long as you like the strike price that you sell, and then you can go up to an expiration date that you choose. I prefer expiration dates that are 1 to 4 weeks, and that's because options are typically decaying a lot and they're losing a lot of value, which is a good thing because if you're an option seller, all that decay, that theta, it's called theta, you are actually collecting that. So you're making really good money and you're coming in when an option's already decaying to its fastest point. And that is really good for your portfolio so you can make money and have a very fast return. Now, in exchange, the covered call seller receives a premium. So that's what I mean when you're making money. When you sell a covered call, you're collecting premium upfront. This upfront money comes right into your account. So say that you sell a call option for $1, okay? That dollar is going to be $100 because each option is 100 shares. So $100 is going to enter your account, and boom, you can take that $100 and reinvest it. You can earn interest on it, or you can do whatever you wish with that $100, right? But I love selling options because as soon as you sell an option, that money is yours instantaneously in your account. Now, the covered call seller has the entire downside risk of the underlying security minus the premium. Now, this sounds like a really bad sentence. However, if you're a stockholder, you have downside risk anyways. If the stock falls by $5, as a stockholder, you lose $5. But as a covered call seller, you also lose $5, but you now have a premium. And this premium is your cushion. That is why I love covered calls, because they build in a cushion into your portfolio. They essentially create a margin of safety. And the upside potential is limited, but you can still have upside potential. And as long as you're using technical analysis to determine what strike that you want to sell, it's really not that bad because you're collecting a premium, you have a margin of safety, and you still have upside. You just don't have unlimited upside. So why is selling covered calls one of my very favorite strategies? How did I use covered calls to grow a $1.4 million portfolio? Well, it's actually very simple, okay? the number one reason why I want to sell covered calls is because they increase income by the amount of premium received minus commissions. And with Robinhood, you don't have any commissions, right? But even if you have some commissions, no big deal. Whatever you're selling in terms of premium, that is yours to keep. And the worst thing that can happen is you lose your stock at a higher price. Not that bad. If you lose your stock at a higher price, you have capital appreciation on the stock itself, and the premium is always yours to keep because it enters your account right away. As soon as you sell an option, it's in your account instantaneously. So I love covered calls for that reason. They bring in premium, which is income. Now, also, again, I said they slightly reduce the stock price risk by the amount of premium that you collect. So let's say that you have a stock at $100, you sell a covered call. Now with this covered call, you go a little bit longer in terms of date on a very volatile stock. So say it is a 3-month option, you collect $10. Well, great, you've reduced your price from the current stock of 100 to 90. You've actually went down to $90 because you've collected $10. So let's go over an example. Let's say that we have Apple stock. I know Apple is more than 92, but let's just say we have Apple stock. It's $92, okay? If you go long 100 shares, that's $9,200. Okay, of course you can pick a cheaper stock. I'm just using this as an example because I don't know what your specific portfolio size is. So Apple is a very standard that I do make. So let's say the market forecast is neutral to moderately bullish on the stock, sort of like the market that we're in right now, right? We had a sell-off, we were in a long bull market, now it was a bear market, now we're somewhere in between, but kind of moderately bullish because we are seeing some recovery in the stock market. I mean, specifically, if I look at my portfolio, I'm up 10% in the past month. So we are seeing a recovery. Many stocks are recovering. Now, what you would want to do is if you bought 100 shares of this stock, you can now sell a call option, okay? So let's say I bought it at 92. I can now go ahead and sell a 95 call option. Don't pay attention to this date. This can be any date that you're watching this in the future. It can be in November 2023, it can be October 2027. It doesn't really matter. Options are always the same thing. You want to sell options predominantly, and you want to do so a little bit out of the money in the next 1 to 4 and even 6 weeks out, okay? So I have this stock at $92 and I sell the 95 call. So I sell it for $1. So I'm long 100 shares at 92 and then I sell one Apple 95 call, okay? So what this means is I am ready to sell Apple at $95. So should this stock go to 95, I will have to get rid of the stock. Now, in a little bit, I'll show you how to manage that position towards the end of today's presentation. But, basically, if it goes to 95, I have to get rid of it. However, I've collected $1. So actually, I'm turning $92 into basically $96. Here's what happens. If the stock goes to $100, then I will have a profit of $4. If the stock goes to $95, I still have a profit of $4. That's because $4 is the maximum amount of money that I can make. It's because 95 minus 92 is $3, and then I collected $1, so that's $4, okay? So regardless of how high the stock goes, I have collected $4. But there is some advantages to this. So as a stockholder, sure, you make a little bit more money, but let me show you why this is so beneficial. And actually, you can already see why, because if the stock goes to 95, the stockholder makes $3, but you've made $4. Now, let's say that the stock falls down to $91. Well, you've collected $1 by selling the call, right? So a stockholder lost $1, you've actually sold premium for $1, so you're actually break even. While the stockholder is kind of hurting for $100, you're actually at the break even point. Now, let's say that all the way the stock goes down to $80. Well, that's actually fine too, because a stockholder lost $12, but you've lost $11. So basically you have a small margin of safety here. And of course, it's very hard for Apple to fall from 92 to 80. What will most likely happen if it's a bear market and the stock is falling, your option will expire. You can sell this $1 premium many times over and over, right? So you can sell it $1 maybe 3, 4, 5 times. So the stockholder might be down $12, you might only be down like $7. So it is very beneficial to have covered calls in your portfolio, both for the margin of safety and cushion that it provides your stock holdings, but also for the income that you're generating. So covered calls are safer than stocks. Anyone that says options are risky doesn't really know what they're talking about. They're risky for some people because some people end up buying call options, hoping for the best. They buy out of the money call options like they're in a casino thinking that this thing is like, hey, I'm gonna bet on red and this thing is gonna go to the moon. That's not how you trade options options consistently for income. That is completely against the way I teach my students in my Discord community from making money. No wonder you're not going to be successful that way. I mean, you're going to have very huge swings in value in your portfolio. Instead, I prefer selling options because that provides consistent income, and consistency is what it's all about, because I want cash flow so I can live my life and not have to worry about my portfolio making very huge swings in value. Now, let's keep on going and talk about covered calls on a profit and loss chart, okay? So this is long Apple at $92. Notice this green line is the stock. The stock can go to the moon, right? It can keep increasing in value up to right infinity. The stock can be $1,000 and $2,000. This yellow line is a covered call. You can see that it's higher than the green line for almost all of its instances, aside from right around here at $96. That's your break even. You can't make any more money, and then the stockholder will make more money than you. However, you're better off than the stockholder most of the time, and you do have a cap. But let's just say that this is a weekly option. It is not bad at all to make $100 a week on a $9,000 account. It's not a large amount of money, but $100 a week, $400 a month, right? So now let's say that you 10x your account over time, you keep adding money into your portfolio, you're doing some of the small account strategies that I teach in my playlist, which I'll also have in the description. You should absolutely check out. I show you small account strategies like spreads. But basically, let's say that you grow your portfolio to $90,000 in the future. Now you're making $4,000 a month. That is insane. That's amazing. Most people can live on $4,000 a month and completely replace their income with a $90,000 portfolio. It's not even that much money to have. I have some clients that have $900,000 portfolios and they're making tens of thousands of dollars per month. So it's not hard to scale a smaller portfolio over time. It's just most important that you actually scale and not make the mistakes by yourself and go through the very long method of buying call options like you're in a casino. Instead, selling options is very, very profitable and consistent so long as you use technical analysis and the other things that I teach in my Discord community and on this YouTube channel. And I'm always sending tips Monday, Wednesday, and Friday in my email newsletter, which you can always sign up for in that first link in the description like I mentioned before. Now, let's talk about the next thing, which is buying to close, rolling, and really letting these type of positions expire. This all comes down to strategy management and how you are managing a covered call position. Now, there's many ways to manage a covered call position. Let me scroll back up here and show you. Basically, let's say that you sold a covered call for 1 week out and Apple stock goes to $96.25. Okay, it's slightly higher than the break even. It's gonna be somewhere around here, right? What you can do, there's a few things actually. You can either let it expire and just sell your stock. That's totally fine. You can also roll this position. A roll is just closing the option and opening up a new one. Okay, I'm not gonna go into crazy detail. That is my rolling video in my option playlist. But you can let it close, which is basically getting assigned and losing your 100 shares. You can roll this position, or you can also buy to close and just leave your shares, right? You might experience a small loss, but actually, if the stock is $96.25, you're only down $75, but you've collected $1, so you're actually still up about $75. And I meant to say you're only down $75, and if you sell another covered call for next week, you're gonna collect $100, you're gonna be making up all of the money that you're down in just 1 week. So it's not really that big of a deal. But what I typically like to do is I like to just let the position expire. I'll lose my shares and that's completely fine with me. However, if I've had the shares for a long time and I don't want to lose them for tax reasons, then I will roll them. And again, that's a separate video which you can watch on my channel. Now let's talk about my other favorite strategy, which is selling cash secured puts. Selling cash secured puts is also a fantastic way to grow an account and to grow your account pretty fast and to also get a margin of safety. This is very similar to covered calls. So what is a cash secured put? Well, it's selling a put and simultaneously setting aside cash to fulfill the obligation if you get assigned, right? Should you get assigned, you have the cash available. So let's say that HIMS is $5.50. If you sell the $5 put option, you might make some money, right? You might make $20 or $25, but you need to set aside the $500 in your account to collect that $25. Not bad, because $25 on 500 is about a 5% return. You could probably make that in between 1 to 4 weeks. That's an example of a cash secured put. I'm going to show you some more visual examples like I did with the covered calls. But basically, the cash secured put seller has an obligation to buy stock at a strike until the expiration. So let's say that you sell a 5 strike on HIMS and the stock goes to $4.90. Well, you're obligated to buy the stock for $5. So why would you want to do that? Well, basically because you make money, you collect premium again, and actually you can buy the stock for lower than it's trading at in the market today at this very moment. So the profit potential is limited to the premium that you receive, but it's a pretty safe strategy. There is substantial downside risk, just like with the covered call, but again, it is substantially lower than just owning stock. So if you're a stock investor, selling cash secured puts makes way more sense than just being a stock investor, especially in some of the most volatile markets. These days, you can save way more money by selling put options and still earn a really handsome amount of money and income on a weekly and monthly basis. The amount of cash necessary to cover the obligation is required in your portfolio, but there is some things that I teach in my Discord community, like selling puts on margin. But it is not a beginner-friendly strategy, so I really recommend that you have the cash in your account so you are cash secured. So why do you want to sell cash secured puts? Well, basically, when you sell a cash secured puts, let's say that the stock is $100 and you want to buy it for 90. Well, actually, you can buy it for 90. Not only that, you can get paid to buy your stock at $90. So you can have a target for your buying price. You literally set that strike price and you buy at the price that you wish, and you earn income, and the income that you earn, you can put into something else. You can earn interest on your cash, or you can sell some more put options or do some more covered calls with all the income that you're getting. Or you can put in spreads, which again, I cover in my small account playlist. So here is the cash secured put strategy. It is basically a strategy that you can use in all markets because it's safer than buying stocks, and you can always buy stocks, right? We never really know if the market is low or high or medium. We just want to dollar cost into the market. Well, rather than dollar cost averaging into the market and buying index funds, why not sell puts on high volatility stocks that actually have a high degree of certainty in some cases, like Amazon, Google, and some of the other high quality names out there? You can actually sell puts on them, make a really handsome amount of income, and actually buy them for cheaper than they're trading at today. So let's go over an example. Let's say that you have $9,000 of cash in your account, and Apple, again, is about $92 per share. But this time we're going to be talking about selling a put option. So let's again say that the market is neutral to moderately bullish on the stock, which is typically what the market is. It's probably always around bullishness. It's typically always between neutral and moderately bullish. That is typically the market that we're in. Typically markets go up over time. So let's say that you would like to buy the stock if the price dips a little bit. Let's say you do like it at 92, but you want to buy it for a little bit cheaper at $90. Well, what you can do is you can sell one Apple $90 put, and you can do that for $1. So you're going to receive $100. So all you need to have is $9,000 in your account to cover this obligation, and on $9,000 you can make $100 per week. So this is how a cash secured put works. So let's say that you sell the 90 put for $1, okay? If the stock is 100, well, that's good. You still made your dollar. If it's at 95, that's good. You made $1. If it's at 90, that's good, you made $1. However, do keep in mind at $90, the stock investor has already lost $2. So he's down like $2, which is 200. You're actually up $100, which is a whole 300 more than a stock investor, someone that just buys the stock at $92, because you're selling the 90 put. A little bit out of the money. Out of the money just means that it's not at 92, it's at 90. It's a little bit lower, okay? Now let's say that the stock goes down to 89, okay? The stockholder has lost $300 at this point, while you are actually at break even. So again, you're still $300 better than the stock investor out there. Let's say the stock goes all the way down to $80, okay? The stock investor has lost $12 while you have lost $9. So you're still $300 better off than the stock investor. You guys can actually see the chart right here where you are the yellow line. You're always doing a lot better than the stock investor in all of these areas, so long as the stock is under around this area of $93 per share. Now, of course, you're capped. You can't make any more money, similar to the covered call. You can't make any more money, and the stock investor can make more money than you if the stock blows out of the roof and it keeps rising. But on a given week, this isn't really going to happen. And selling puts and collecting premium is going to make way more money long term than just owning stock. This is the exact strategy that I also use to enter stocks for much cheaper. As you can see, I have sold a put on Airbnb, on Nvidia, on Oatly again, on Google, on SPY. I made $2,000, $400. I'm making hundreds and hundreds, and in most cases, tens of thousands of dollars on a monthly basis by selling put options and covered calls. And these are my two favorite strategies. They're super simple to run and to have in your portfolio on a long-term basis, and they're not that stressful. They're way less stressful than a lot of the small account strategies that are very high risk. So let's talk about closing a put that you sell, okay? So you can always buy to close. Say you don't want to get put the shares, you can always buy to close. Now, I don't recommend buying to close because hopefully you're selling puts on stocks that you love, right? You want to own that stock. So you sell a put on it because you want to own it to begin with. So Number one, you can buy to close, but I rarely, if ever, will buy a put to close because it typically doesn't make any sense. Now, rolling is something that I do, which just means, again, I close a position, I open up a new one, which I have a video on. Won't go too deep into rolling, but rolling is closing a position that's not working out and turning that winner into a neutral position or even into a winning position by selling a little further out in date, okay? That just means that I let it expire and I collect 100 shares of that stock at, for example, for Apple, it's gonna be at $90, right? So I've sold a put option at 90, so I would buy it at 90. The stockholder invested in the stock at 92, I got it for 90, plus I got my premium of $1, so for me, it is a huge win. So let's go over the summary of selling options. So selling covered calls, you have the obligation to sell stock at the strike price up and until expiration. The downside risk in the underlying security minus the premium is important to pay attention to. But again, minus the premium, so you're safer than the stock investor, and your upside potential is limited. Same with selling cash secured puts. It is limited, but you can still have a very good income generation on a weekly and monthly basis while still actually having some upside potential. Now, for selling cash secured puts, you have the obligation to buy the stock at the strike price until expiration. So you can actually buy the stock for cheaper than it's trading at today. This is literally one of my favorite strategies. I love selling cash secured puts. They are amazing. So the profit potential is also limited, as I mentioned. There is substantial downside risk, but again, it's less than being a stock investor. So not really worried about the risk, and the amount of cash necessary to cover the obligation is required, right? Just like it is with covered calls, you need to have 100 shares. For cash secured puts, you do need to have the cash in your account. And these two strategies are awesome for income generation. Just keep in mind before you place a trade to consider buying or selling one call is equivalent to 100 shares of stock. So it is a significant amount of leverage in your portfolio, which offers you to make a lot of money, but also be careful because you want to be diversified. Be aware of the position sizing that you have. Make sure no one position is more than 10% of your portfolio, and consider how much risk you are comfortable taking. This is done through trial and practice, but you can also follow all my trades in my Discord community. And of course, as I mentioned, I am sending 3 emails a week for free, and you can sign up for that in the first link in the description. Thank you so much for watching.